Global markets are fast, powerful, and interconnected. A shipping delay today could lead to oil prices hiking up tomorrow. A small interest rate slash today could lead to billions leaving your economy tomorrow. And the decisions of a president in a foreign country thousands of miles away can affect how much you pay for fuel, food, and services. So what do you do? How do you ride the waves of the ocean that is the global economy? Well, that's what we're here to find out today. My name is Iyque Onyenwe, and today with my co-host Iyque, we'll dive into the markets in motion and understand the drivers of the global economy and how that affects you. With us today is Mr. Iyque Onyenwe, a capital market expert with over 21 years worth of experience in core treasury functions and capital market trading. He has traversed global markets, trading CFDs of commodities, indices, and cryptocurrencies. He has worked at prestigious companies like Fidelity Bank, Greenwich Merchant Bank, Zircon Advisory, and Main Street Capital. When he's not trading the markets, you can find him listening to classic 90s music and playing FIFA 26 on his PlayStation. Mr. Iyque, welcome to the show.
I'm pleased to be here.
So, real quick, I want us to look at the global market overview. So with what's happening in the world right now, the Middle East conflict, the oil price surge, and what's the global market reaction to all of this?
When you talk about geopolitics, what readily comes to mind? Just imagine the game of chess. Two players on the board. You know your strategy, the other person knows their strategy, but you can't read the mind of the other person, and one wrong move, you're out. So that's exactly what's happening in the world right now. The moment America and Israel dropped the bomb in Iran, world economy changed, at least for now. So that is why we saw the prices of oil skyrocketing. The movement was so rapid that before we could blink, oil price has moved from $50 a barrel, that's WTI, all the way to about $120 per barrel, and that changes the narrative in the global market.
Also with that, we can see that with the oil price surge, we can see that the Strait of Hormuz, which gives way to like 20% of the world oil, has been closed, or there's no passage for a lot of the ships. And then this has caused countries to enter into a state of panic because their reserves are going to start drying up soon without any backup. So what do you think? How do you think this will affect everybody?
Okay, talk about the Strait of Hormuz. It controls about 40% of global oil and gas. If you check the map, you would find out that it is just a very small, narrow channel, but it controls the movement. All the rigs around from Bahrain, United Arab Emirates, moving Kuwait, Oman, even Iran itself. From that small strait, it moves to China, moves to India. So, but if it doesn't move from there, it doesn't get to China, it doesn't get to India. So global economy is energy dependent. China is a production powerhouse. Japan is a production powerhouse. India too has become a production powerhouse. And with the lull in movement of this ship carrying oil to these places, then the world economy is bound to, at least in the time being, is bound to suffer a shock. And that's exactly what we're seeing.
Okay, so the US, who started all of this alongside Israel, it said that right now their dollar is strengthening because everybody wants to convert, because it's the petrodollar, everybody wants to convert their currency back. Do you think this would affect other economy? Because right now other economy are going to be affected. What do you think about this?
Yes, to answer that, we'll have to look at the strength of the petrodollar, how it all started. And I think it dates back to the 70s when the dollar was used as a currency to back oil trades, and that strengthened the US dollar. So as a result of that singular act, all trades, no matter where you are on the face of the earth, you have to pass your transactions through the dollar. So that strengthens the dollar. And because the dollar is the world's reserve currency, whatever you want to do, you have to pass it through the US dollar. So in terms of geopolitics or geopolitical events, there's what we call flight to safety. And in this case, the only safe currency is the dollar. Currency. So the currency that is safe whenever there is uncertainty is the dollar. And that is why there's this flight to the USD, at least for now, despite the fact that the president is interested in weakening the dollar. But because of the geopolitical event, the dollar is strengthening.
What I want to know is, how are some of these markets connected, right? Because from what we said now, I'm hearing like 2 or 3 different things. One, you have oil, right? You have physical shipping lanes, the Strait of Hormuz, right? Then you have oil, and then you have dollars, right? So now we know that there is an interconnectedness of markets, and because of the relationships between certain markets, when certain events happen, are there certain things we should look out for? For example, anytime there is any sort of problem in the Middle East, oil goes up, right? Stocks come down, right? So why? How are these markets connected? One, then different types of scenarios, so that for our listeners, right, if today it's the US bombing Iran, what if tomorrow it's Russia bombing Ukraine? What should they expect? Should they still expect the same things that are happening now, or an entirely new different set of outcomes because of some of the relationships between maybe the US economy and Iran oil is different from maybe Russia, and the effect that the Russian economy has on Russia has on the global economy? So how are some of these markets connected, and during different scenarios, what should people kind of look out for?
Okay. I'll have to start by saying that there are 3 core things to look out for. One, foreign policy. That is, it discusses how nations deal with themselves. Then 2, you have trade relationships. Countries are allowed to do business with themselves. And then the third one is interest rates. By interest rates, we mean the cost of money. So let's talk about foreign policy.
Okay.
When 2 nations are in a skirmish, whether it's a blown war, full-blown war, or just a misunderstanding, then that affects their relationship. And the moment their relationship is affected, if the countries involved in this skirmish or full-blown war are powerhouses to global economy, then it affects global economy. You talked about oil because of what is happening in the Middle East. The Middle East is a seat, or let's call it the energy powerhouse of the world. Yes, there are other places where oil can be gotten, but it is more in the Middle East. So you can imagine what happens when there is a full-blown war in the Middle East. There is no how it will affect global energy. So that is what we're seeing. Then we talked about number 2, trade. So you reference to Ukraine and Russia. When that happened, I think in 2022, when it started in 2022, we were talking about world grain production dropped because Ukraine is seen as the seat of the world's agriculture, because they have that atmosphere to support the growth of this agricultural produce. So as a result of the war with Russia, it affected food pricing. And then the third one is interest rates, the cost of money. When interest rate goes up, your money becomes expensive. So it's good to hold. It's good to hold the dollar, but it becomes expensive to spend the dollar. Interest rate goes up. If you have mortgages that you're servicing, the rate goes up. So the money in your pocket loses value as a result of that hike in interest rate. But the currency whose rate has been hiked becomes stronger. So all of that, they're interwoven. So maybe when we get to the point where we'll be discussing emerging markets, we'll see how those, the concepts I've talked about, how they trickle down to the emerging markets.
So far it's so whenever there's like an issue with countries, you first have to figure out what that country is known for in the global markets.
Absolutely.
So the reason why we're seeing the problem with oil right now is because in the Middle East is oil. So if the US has sent their rockets to Ukraine, then it will be food prices that would.
Absolutely.
All right. That's good to know. At least that breaks it down. All right. So let's talk about the FX. We said interest rates, and interest rates are, the cost of money, right? Can you explain that when you say the cost of money? Because I can imagine the random viewer listening to this and thinking, what do you mean the cost of money? I mean, I work, I get paid. What does that cost?
Okay. Let me use a typical example. In Nigeria, you are supposed to pay for something. That's the cost of living, your rent. Or even the business person out there wants to get a facility so that they can pump some money into their business to expand their business. Now, how difficult or how easy do you think it will be for that business person to access this facility if the interest rate is high?
Yeah, it will be tough.
But what happens if the interest rate is low?
They can easily get.
So the cost of money is the interest rate. If the interest rate is high, it makes it difficult for you to access facility. Now, even if you access that facility, is expensive to you. Now, the impact is also on inflation, cost of living. Once the interest rate is high, then your cost of living goes up because the naira that you have in your pocket loses money. I don't know if that's clear.
So when the interest rate goes up, the cost of living goes up, and the naira you have loses value because other things are more expensive. So you need more naira to pay for it. So is it the reverse when interest rate goes down?
So there's more monies to spend. So you have what the economists will call more disposable income. So you see people want to take up more loans because maybe what they have, for instance, you are on a particular salary scale. If the interest rate is high, it will dig more into your pocket for you to service that. Sorry, I didn't hear. Your purchasing power, that's the word. But on the other hand, let's hold your salary constant. It's still the same, but here the interest rate is lower. You can do more with what you have. So at that point, you can either invest in yourself, buy more clothes, maybe touch up your apartment because you have no money. So your lifestyle can actually improve as a result of that. And you can even invest. And from investment, you'd even get more returns. And so all of that happens. But once the interest rate goes up, it strengthens the currency in the face of the foreign investors. But you, the locals, your purchasing power reduces. So it makes your propensity to spend drop.
Okay. I think that actually explains it now. So now let's talk about the USD, right? Because in Nigeria here we love US dollars, right? USD is trending. I think over the last 1 week, it has gone from like 1,300 and something to 1,400 and something. So first thing is, why is that happening?
Okay.
Right. And what is the implication, right, for if that keeps happening for Nigerians right now?
Okay. Nigeria is an import-dependent economy. Yes, it is true that we export crude oil, and so there's accretion to the foreign reserve as a result of our crude oil sales. But there's what they call balance of trade. So if you look at your foreign reserve and the accretion is more, as in the addition to your foreign reserve keeps growing, that means you are positive, meaning your expenses that are usually debited to your foreign reserve is not as much as what is coming into the inflows and the outflows. So in the case of Nigeria, all of a sudden, I think recently during the 304th MPC, the CBN governor said our foreign reserve stood at 50 billion, a little over 50 billion, and that is the highest in 13 years. So that's some confidence builder. To all of us, the locals and then the foreign investors. One, why the foreign investors will be interested is they are looking at your ability to repay your loans, and you have a very good buffer. Then on the other hand, your balance of trade, your naira is strengthening. And because we are import dependent, so it means that the strength of our naira against the dollar has moved up. It has strengthened against the dollar. And so it is cheaper when compared to maybe a few months or a few years back. So once you consider those two, yes, for the locals who are spending naira, because naira has strengthened against the USD, imports are cheaper and it makes us happy. But the moment the naira starts depreciating against the USD, and it makes our imports, most especially things like food, cars, electronics, it makes them expensive. And the moment they are expensive, it takes more from your pocket than it used to be.
Okay, so I want to ask a question regarding that, because in January of this year, we recorded our highest trade surplus in a very long time, in years, and that is due to because we're exporting more crude and we are not importing as much as we used to, which has increased the buffer, like you said. So now, because of this oil war that's been happening, investors are scared, they're pulling out and everything. So what I want to know is, if this upset had not happened in this past few days or months, what do you think would have been the outlook for Nigeria in terms of the foreign direct investments and in terms of our trade surplus and our reserve and everything in general?
The war is not a Nigerian war. It's happening over 5,300 kilometers away from Nigeria, somewhere in Iran. So it's not a Nigerian war. But like you asked, if the war wasn't started by the US and Israel, yes, our foreign reserve will continue to grow. Well, it's actually still growing. It's growing. But there's some pressure on the foreign reserve right now. And that pressure is due to repatriation. So it is a different story.
Sorry, what's repatriation?
Okay, so when we say repatriation, we're talking about the foreign investors who had brought in monies into Nigeria before now. Let me use this as an example. Let's say a foreign investor inflowed $1 million into Nigeria sometime in 2025, say January 2025. And with that, the question is, why would they inflow funds into Nigeria? Because they saw an opportunity in Nigeria. Our exchange rate was probably at 1718. So at that point, they will sell their $1 million to the CBN and buy naira. With their 1 million, what would they get? Maybe 1.7 billion or 1.8 billion naira. What would they do with that naira? They will invest in your 1-year zero coupon bond. And at that point, our zero coupon bonds were trading around 23%. Now do the maths. They invested 1.7, 1.8 billion, right? And they held it for 1 year at 23%. On maturity, they get something like a 2.2 billion. Now, where are we in terms of exchange rate? We are somewhere around 1,300. So imagine them buying back the dollar they sold to us at 1718, buying it back at 1,003, 1,004. You end up making $1,600,000 or $1,700,000. These were the same guys who came in with $1 million. Now they have made a profit of 60 to 70% in 1 year. What do you think will happen to their profit? So the war that has just been triggered by the US and Israel is making it even easier for them, or has given them a reason to repatriate, to move their funds back to their country. So that's what repatriation is. So you've made monies after investment. Now you've made profit. You want to send it back to where you're coming from.
So how much of this foreign portfolios, right? Because that is going to put pressure on our reserves. But then it depends on how much of those monies came in, right? So if it's a 1 million to maybe 1.7 million out of 50 billion, that's easy. We can easily pay off. But how much of that money is circulating that could potentially be repatriated?
Okay. The beautiful thing about the central bank is that they created a window so that the pressure on the naira will not be instantaneous. So that means even when they came in, they will buy what we call NDF, non-deliverable forward. So that means at the point when they're coming in, you can buy forward. And different people will come in at different points and they are buying forward. So that means even if as of January they had come in with like 30 billion, we will not feel the shock because they are not all leaving at once. It is the maturity of their NDF that determines when they will leave.
Okay, so essentially we don't need to worry about expecting like a significant dip in at once because they are leaving. Okay.
To show us the pressure too on our foreign reserve, in the last 3 weeks, the CBN has been intervening in the market, in the FX market. So I think it started with them intervening with about $200 million. The following week, they did another $200 million. And just last week here, they did $500 million. So it's a gradual thing. Let's not forget that we're not just facing the foreign investors who are repatriating. We also have trades to pay for. Like I said, we are an import-dependent economy. So people would also want to take advantage of the fact that the dollar dropped. Some people, some citizens who have properties in the US would want to buy dollar now at 1.314 to service their mortgages, which wasn't possible. Then some would also want to pay for their children's school fees, which was it was tighter for them, but now at 1.314, it makes it easier. So the more the foreign reserve keeps accruing, increasing, and the more foreign investors will feel comfortable and keep inflowing. And so in this case, we're talking about supply outstripping demand. So rate will continue to. But right now, what we're seeing is the demand for dollar is actually increasing because of our imports and then the repatriation we talked about.
Yeah, because you said 500 last week, 200 previous week, and so in like 1 month, that's almost $1 billion. So one thing that I guess viewers need to keep an eye on is how much of if the reserves keeps going up, keeps climbing, and how much demand is in the market right now, and that will affect interest rates, exchange rates rather.
I like the fact that you mentioned that. So I would always say, don't focus on the rate, focus on the reserve. The news around the reserve. That should be of interest to our dear listeners. Don't just focus on the rate. Yes, it's fine to know what the rate is doing, but it is more important to focus on the reserve because that's actually the basket. Once it starts depleting, so that's where you should be concerned. But the rate could actually hover and the basket is still full. So there's actually nothing to worry about.
I like that. That's actually alpha. So it's like if you want to get a gauge of where exchange rates are going to go, just keep watching the reserves. And once the reserve starts to dip, you know that, okay, exchange rates are most likely going to fall. And then you can get ahead of that. And that's actually very practical for everyday Nigerians. All right. So now, talking about interest rates and relative value of currencies, there's something called carry trades, and I just think it's an interesting concept, and I know there's something that happened, was it 2025 or 2024, where the Bank of Japan hiked interest rates, and then 4 trillion left global economies, right? Because people had taken loans from the Bank of Japan and converted. So I'm bringing it up now because it affects Nigeria, because you say interest rates are the cost of money, right? So for foreign portfolio investors, right, you said an investor, let's say, bring in $1 million. For that investor to bring in $1 million from the US for a market like Nigeria, where we have the exchange risk, it means there's something here that he sees that he can't get in more stable economies.
Yes.
Right. So I kind of just want to now just touch on, that kind of dynamic, and what it means and how it works.
So what you have just explained is the same with the carry trade that happens in Japan. But we'll look at it slightly differently. In Japan, their interest rate is near zero.
Yeah.
So that means with their yen, if you invest in Japan, you're not getting anything. So what do? They borrow at near zero interest rate. And having borrowed at near zero interest rate, they move it out of the country, maybe to the US, where their interest rate is at 4,
Okay.
for instance. Now, with that dollar purchase at 4, they buy the USD, invest maybe in their fixed income instrument at 4, or even their equities market that at that point is expectedly at their lows. And so they will be the ones to prop up demand for it and then push the price north.
Yeah.
Now, for the investors from Japan is positive return because the cost to you is zero. Or you're repatriating, you're sending back to pay down your borrowing that's at zero cost. And so you'll make positive return. So now let's look at Nigeria. I painted a picture earlier where they come in with $1 million, and they're leaving with $1,600,000 or $1,700,000. What does that tell you? So that means there's something we're offering here in Nigeria: interest rates, and exchange rates. Now let's not forget that for the exchange rate to drop, for naira to appreciate, and that means more dollar has to flow in.
Yeah.
So what I observe most foreign investors doing, most especially the first comers, they take advantage of the fact that they are the first to come in. So what they do is, after they've inflowed dollar into Nigeria and they've bought our instruments at high interest rates, the next thing, they will now go on different media platforms and start directing attention to Nigeria. Oh, Nigeria, the investment destination of choice. What are they doing? Inviting others to come. Don't forget, they've already invested at 23. When the next person comes, the next person brings in dollar, sells to the market. The first person that came in probably sold at 1.8. The next person that will come in will sell maybe at 1.7. The third generation will probably sell at 1.6. And don't also forget that the first person to sell at 1.8 invested at 23. The second generation that came in at 1.7 will invest at 22. The third generation that will sell at 1.6 will invest at 21.
Right.
And before long, the last generation that will come in will sell to us at 1.3 and be investing at 15%. So what happens to the first generation? Oh, they've actually stayed 1 year. They've made like 60, 70%. You don't expect them to keep staying. So that's where the pressure starts. The first generation will start, the investment has matured, they will buy back their dollar, and then they move it back to their country of origin. Second generation will do the same. So it's a circle. Once you understand that circular movement, you'll be able to profit from the market.
I think from what you've said, it's just like having a first mover advantage. And you were saying some area that you will come back to making markets, but I think they're here right now. Yeah. So I think basically what people do, this is for our viewers now, because information is actually very important, because from what you said now is having the right information to know the developing economies, have dollar interest rates, and the emerging markets, the interest rates are higher. So they're arbitrary. They were
Absolutely.
take from here, invest it here, and make more money.
Absolutely.
So for our viewers now that don't really have much, they're young people, they're trying to find a balance, they're trying to know the markets more, what would you advise them to do, like in terms of knowing, having these informations, using opportunity like arbitrage their advantages? Like what would be advice there?
They should get interested in the financial markets. That won't stop them from their everyday life, but they should get interested in the financial markets. So they should understand the equities market, because there are movers in the equities market. Foreign investors also are interested in the equities market. They should get interested in the fixed income market. And thirdly, they should also get interested in the foreign exchange market. So what that simply means is once you get interested in this kind of market, even if you don't have the expertise, you should approach asset management companies to guide you, like Main Street Capital, and approach them for financial advice. They would guide you on how to do what we call diversification of your portfolio, because these markets don't move in the same direction at the same time. No. So it could be the fixed income market moving first, then later the equities market. It could also be the exchange market moving, and then others will follow. So that is where Main Street Capital comes in to provide guidance that would expose you, the listener who is interested in financial markets, to invest. So what we'd always say is have a bit of everything, because one will serve as a hedge. And then the other ones, when this is moving and this is down, you have a hedge. And so there's actually no need to panic. But if you are skewed only in one direction, then that's why you panic when the foreign investors are getting up.
Okay, I think I understand your concept, but you mentioned equities market now. So I also take at you something, because even to me, I don't really understand it. So with the war in Iran and the shock in global markets, other countries like Asia, the equities market is dropping. Some has done, they've gone 6% down. The European market too, S&P is down. But it's seeming not to really affect us in this part of the world, because there's still some positives from this end. So what do you say is our own driver? Like, is it different? Why is the shock here not as much as it is in other countries and continents?
That's an interesting question. We're not immune to global shocks. I need to assure you.
Yes.
So it might not happen immediately, but it will happen. So there's something we'll call market correction. So for instance, the all-share index was just some point shy of 200,000. And then all of a sudden it's pulling back. And some would attribute the pullback to global events. But first and foremost, we need to consider the composition of the Nigerian stock market. How much of foreign investment do we have here, and how much of domestic investment do we have here? I can tell you authoritatively that right now it is skewed in favor of the domestic investors. And that is why we're not experiencing that shock. Now, the foreign investors will eventually come. Now, if you check individual stock prices, they've rallied since 2023 to they've rallied. So for the foreign investors, they're expensive. So what would they do? They'll wait for the pullback. So right now, I believe the foreign investors are doing their homework. They're checking for pullback levels. That may sound technical. Yeah. But pullback levels means the areas where you're comfortable buying a stock. So just take this, for instance. You want to buy a pair of shoes. You've been eyeing this pair of shoes for a while. And whenever you get to the market, they tell you, oh, that pair of shoes, say 100,000. You don't have 100,000 to pay for that shoe. But every day you keep refreshing the site to see if it's on sale. Why are you waiting for it to be on sale? Because at that point, you're comfortable buying. So right now, the Nigerian Stock Exchange is not on sale. It's not on promo. It's expensive, just like the shoe at 100K is expensive. We're almost at 200,000 points as the all-share index. Now, the all-share index is composed of different individual stocks representing sectors. So recently, the oil and gas sector that has been quiet all of a sudden moved as a result of what was happening. So that is why what we provide is guidance on sector rotation. Buy some of this sector, buy some of that sector. When this is moving, you're cashing in, you're making money, whereas this other one isn't moving. But when that starts moving and they're taking profit here, you take profit and allow this to work. So that's putting it simply.
Okay, I think earlier you mentioned diversification, and this is just
is an example of it.
One or two examples. So in the beginning when we started talking about foreign direct investment, so it's more like the foreign investors are more focused on fixed income
Yeah, more.
right now because of it's more stable for them and they understand it better than our equities markets, which maybe they don't really understand.
No, they do. Don't get me wrong, they do. Like I said, the pricing
Okay.
may be expensive for them. For instance, if you look at certain stocks, let me use a typical example. Nestle. Nestle is currently at an all-time high. What would you do? What would a foreign investor do? It's already at an all-time high. So that means there's no headroom. So what they will do, or what you should do, is allow it pull back a bit, buy it, and then take it back, either to the all-time high that it just created or create a new high. So for a foreign investor, it's expensive because there's no headroom. The headroom for them is the profit. So even if they come in now, they are looking at fundamentally sound stocks that are already cheap, that have pulled back. And I don't think there are many of us.
Okay, I get you, but with the way our market is right now, do you think there will be a pullback with a rally from different sectors, like you mentioned? Would you think there will be a pullback so that would really pull things back, or it's just going to be a little from different sectors, or is this like a very big one?
Okay, to answer that question, I would ask you, if you were told a few weeks back that WTI or Brent, they were trading at 50, 60 levels, and it was hovering, creating new lows as it was going. If you were told that it would rally by almost 50% in a very short while. No.
Well, for us, there's a okay.
Yeah, I understand you, and that's actually what we're saying. So, to answer your question, whether there'll be a pullback, sure there'll be. Pullbacks makes the market healthy. So if you want to see a healthy market, if there's no pullback, it's not a healthy market.
But for the past 2 years now, has that pullback happened?
Yeah, there've been pullbacks. Maybe not of the all-share index. Like I said, the all-share index has various stocks, that it measures, but individual stocks. So you can see pullbacks on individual stocks. For instance, nobody saw that coming. The banking stocks pulled back when the CBN governor talked about forbearance and that the banks with forbearances will not pay dividend. What did investors do? They ran for safety. They sold and kept their naira. When the news about capital gains tax that will be charged on investment was hazy, it wasn't very clear, what did the market do? Market reacted, it pulled back. So those news, those are catalysts for the pullback. So we expect to pull back. We don't know when, we don't know what the catalyst will be, but for a very healthy market, we expect to pull.
Yeah. So I think the market has pulled back, like mini pullbacks though.
Okay.
There was one in like October, November last year.
Yes, I guess.
Yeah. So every now and then,
There were reactions.
they see. But yeah, I think that's very practical because I go on Twitter and I see a lot of people coming in and they are. So when you have market rallies like this, people become financial advisors. I saw this particular account, and I won't say who. I saw this particular Twitter account, and the person normally sells hair, that's her business. But all of a sudden, since January, the person has been talking a lot more about stocks, and everybody's like, buy this, buy that, buy that. But I think this is very practical now because when you see that a stock is at its all-time high, it's not the time to buy, right? You have to wait. But then, how do you know what price to buy at? What price would be a good price? A good discount price to buy at? Because a stock could be 100 naira and you might be thinking, okay, I'm going to wait till it gets to 50 naira. And it never does. It could get to maybe 70 and then go to 200.
Or maybe that is too undervalued, even if it's at the price that's gone up.
True.
It may still be undervalued.
True. So there are a lot of things you put into consideration. So when you say the stock is cheap, it's relative. Yeah, it's relative. like you rightly said, it's stuck at 100 naira. That may be the all-time high, but might still be cheap. So, but that is why at Main Street Capital, what we do is we look at stocks that are fundamentally sound. We call them the pillars of the Nigerian Stock Exchange. So we trade them technically. So using our technical tools, we can tell when a particular stock has pulled back to a level of comfort. So we mark these areas out on the charts, and we use our risk management tool and our other trading tools to ensure that we're not that exposed to the market adversely, that is.
Okay. So we've spoken a lot about markets, global markets, local markets, interest rates, exchange rates, global trade, oil, and even geopolitics, right? So now the average viewer is watching this and thinking, okay, cool. How does it affect my life, right? How does it affect the transportation for the bus I'm going to take? How does it affect, the food I'm going to buy? How does it affect movie tickets for the next Avengers movie that might come out whenever? So how does this affect the regular person, their regular life?
Okay, so I think I'll sum everything in 6 points, and I'll call that the practical takeaways for our viewers. First, pay attention to inflation.
Okay, inflation.
So that means you have to be interested. Inflation affects the prices of goods, services. Your transport to your office or back home is affected by inflation. The oil prices, oil is moving up, is affecting cost of transportation. It's also affecting the cost of moving foods from the farms to the market. So that's inflation. So pay attention to inflation and always ensure that you consume more locally made food and not the imported ones, because the imported ones, as a result of exchange rates devaluation, your lifestyle tends to be more expensive when you are more into foreign made goods. So pay attention.
Tariffs.
And the tariffs, yes, exactly. Then number 2, get interested in extra income. So don't just depend on your salary. Invest. So there's what we call disposable income. So map out all that you are supposed to pay for monthly from your salary. And then some of what is left, or you might actually keep your expenses low and then invest some of your income. Now, that investment, speak to professionals, speak to advisors like Main Street Capital, where you'll be guided on how to diversify your portfolio for income generation. So what that helps you do is, while you're earning salary, your investment is funding your lifestyle. So that means you don't have to suffer. So you can still live the life you want to live just by doing something extra. Don't spend all you make. Invest some of them. And okay, yes, I've talked about the next one I want to talk about is swap foreign goods for local goods if you can. Yeah, there are certain things that we don't produce locally, granted. But if we have a local alternative, do with that instead. That way, it helps you to save more money for investment. I actually wanted to say 4. I'm summing up everything in 4, not 6.
Okay.
And we've taken 3. So the 4th one is watch the reserve news and not the rates. So keep watching the reserve news. What is the reserve doing? So don't just panic because there is a jump in rates and price. Oh, it has moved from 1.3 to 1.4. You panic. No. Check the reserve.
if the buffer is still there, if it's growing, then just take it that it's momentary. It will not last. So that is what I would admonish all of us to do.
So there you have it. The global economy is constantly on the move, but if you know what you're doing, you can easily navigate. Now, don't get distracted by everything that's going on with the missiles flying and everything. Focus on 4 key things. 1, inflation. Keep your eyes on inflation. Is it going up? Is it coming down? What's going on with inflation? 2, save money. And this is something that is fundamental. It cuts across, a lot of different markets. It's a fundamental rule. Always save, to invest. So don't just save to save. Save to invest your money. 3, swap foreign for domestic goods. I know in Nigeria we love to import. We love foreign things, but support local businesses. Take your babe to Booker Hut instead of a fancy restaurant, and support local businesses. And 1, it's cheaper. 2, it helps businesses grow. And lastly, watch the foreign reserve. This is very important because a lot of Nigerians are affected by the exchange rate. A lot of Nigerians want to make money from the exchange rate. And while we look at the exchange rate, it goes up, it goes down. You don't know where it's going next. Look at the foreign reserves. If the foreign reserves remains high and continues to grow, then you know that the exchange rate will follow. If the foreign reserves start to fall, then you know that the exchange rates will do so soon. And stick to those rules, and that helps. And if you need more information, reach out to asset management companies, advisory companies like Ministry Capital, and keep watching our show. We'll continue to interview professionals like Mr. Iyque and tell you what you need to know about the market and about finance. So like this video, follow us on our socials, and drop a comment. We want to know what you think. And as always, stay safe in the markets.